Well, in the previous video, we got acquainted with powerful technical analysis indicators, and in this video, we want to get to know the powerful data, the oscillators of technical analysis, or as we call them in Persian books, oscillators. The first indicator, the first oscillator, or technical analysis oscillator, if we see it in the next slide. Of course, let me mention one point to you. Dear friends, before I talk about the powerful technical analysis oscillator, the oscillator that Mr. Wells Wilder invented, making him the father of technical analysis, or in other words, RSI, or Relative Strength Index, I want to give a brief explanation about the nature of oscillators and then familiarize you with them. You see, oscillators are generally derived from mathematical formulas, a series of mathematical discussions that actually show how we can deduce a price based on past price changes, how we can understand it with respect to trading volume and volume changes, and how we can construct them using moving averages and many other mathematical relationships. In general, oscillators or oscillation indicators usually have a high harmony and similarity with the price chart. That is, they are essentially a simulation of the price chart, but based on the analysis, we bring through calculations, and mathematical formulas. Now, if you look at the next slide, I have presented the three main applications of oscillators here for you. The first application of oscillators is that they are energy gauges. That is, they show the strength of the stock's price chart. They aim to indicate whether the chart currently has the momentum to continue its trend or not. It wants to change its movement. And in the science of technical analysis, we actually refer to this powerful phenomenon as divergence, which includes positive and negative divergence. However, oscillators can also categorize price fluctuations and actually highlight emotional and irrational moments. Most oscillators provide buy and sell signals under specific conditions. So we observe the strength and power of oscillators. The alerts they give us are very useful, and these oscillators also provide us with buy and sell signals. All right, let's move to the next slide. I tried to get some relative help from Wikipedia regarding the first and most powerful technical analysis oscillator, which is the Relative Strength Index. Let's actually have a review of it. You can see its definition very simply. Relative Strength Index, or RSI. Technical traders use it to analyze financial markets and attempt to chart the current and historical strength or weakness of a stock or market based on the closing prices of a recent trading period. This indicator should not be confused with the relative strength line. We will talk more about this topic. If you scroll down a bit, you can see its calculation. An RSI generally has an upper limit and a lower limit. The upper limit is when you take today's or the current closing price or the closing price of the current index minus yesterday's closing price and set your upper limit and take your lower limit as 0 and vice versa. Once again, you actually take your upper limit as 0 and your lower limit as yesterday's closing price minus today's. From these two calculations, when you compute the EMA of the upper limit and actually the end day EMA for the lower limit, you divide them by each other. In fact, you have obtained the RS, meaning you have calculated the relative strength of the stock's price chart. Now, it's enough to index it to reach the RSI. That is, do 100 minus 100 over 1 plus RS. Look, guys, in this training course, we don't intend to delve deeply into the academic topics of indicators and oscillators. I just want you to become familiar with how this RSI is obtained and with what mathematical formula. I gave you a very brief explanation about it, but let's see what the RSI is going to do on the stock's price chart. Well, after those mathematical formulas, we arrive at an indicator, an oscillator, called RSI, which has an oscillation range between 0 and 100, meaning it is confined between the lines 0 to 100, but the 0 to 30 area of the RSI is always referred to as the overbought area, meaning the area of impulsive selling, meaning the place where everyone is scared and selling that stock. The stock market is negative, it has a downward trend, and the conditions are not very good. That's when the RSI is struggling in its 0 to 30 Basu range. But the area from 70 to 100, meaning from 70 upwards to 100, which is actually the peak of our area, is our peak buying area, meaning there are impulsive purchases. The stock is in very good condition. Every day it's green. All the buyers are actually happy and are buying the stock. They are trying to get the stock, but it's not available. And the conditions and the stock are ideal and good at that time when the RSI is struggling in the 70 to 100 areas. But the point regarding signal extraction from the RSI that we can use as analysts is the rise of the RSI above the area of peak selling, or the fall of the RSI to the area of peak buying. This means when the RSI chart, pay attention to the RSI chart, when the chart RSI line crosses itself from below towards, it cuts off at the top. There on the share price chart is a signal. Buy is for you and vice versa. When the price chart RSI, look guys, in RSI itself, it's a diagram, means when we apply the RSI face-to-face price chart of the stock, we create a price chart. We have a separate RSI chart below. When the RSI crosses downwards through below the 70 line, it cuts itself off. It gives us a sell signal for us. And then you see how attractive these buy and sell signals are and how easily you could have seen them with analysis. Before that, you were making a terrible mistake by buying and selling stocks without analysis. Well, I can also get my buy and sell signals from the RSI this way. Let's move to the next step. Well, the point that regarding the RSI discussion you need to know, and many of the other powerful oscillators that we will get to know later, the phenomenon of very, very powerful divergence. I mean, I want to say, guys, every signal we've learned from the RSI so far, and every event that the RSI has created for us, and every alert it has given us, might easily be only 40% of the power of the phenomenon that in this slide you see has. The phenomenon of positive and negative divergence is a very, very powerful one that if the RSI shows it to you, you must act on it strongly and follow it. Let's go to the next slide. I want to bring a few real examples of the positive and negative divergence phenomenon from the market. Let's look at them from different stocks. Let's see different things together. And later we will work on all of these in the software as well. Well, let's see. Yes, I show us what. Look, kids, here we have the stock price chart. My stock price chart is growing over a time period. Let me put this up. Well, we have a time period where we see an upward trend on the chart, but alongside the stock price chart, you can see a chart down here. This is the RSI, or the relative strength index. This blue line you see is the RS, that chart of mine. The limit is RS. I ranges from 0 to 100. We have two important points. This line 3, RS. If I look at this line, from this angle, of course, on this RS, it is seen. We can observe a line at 30, a line at 50, and a line at 70 here. This phenomenon that I have drawn here, I have taken the lines 30, 50, and 70. Then when we go to the price chart of the stock, we actually start our work. You see the lines 30, 50, and 70. That is the RS. I range from 0 to 100. This line is line 30. This line is line 50. And this line is line 70. That is the lines that are drawn here. This area becomes the emotional selling zone. This area becomes the emotional buying zone. From 70 to 100 is this area, the area from 50 to 70, and 30 to 50 we do not deal with. Below 30 also becomes the emotional selling zone. Pay attention to the RSI is moving between these lines and can generally give you different signals. But what does the phenomenon of divergence tell us? Here we have an upward trend, and then on the RSI peaks, would say on the price chart, at peaks, see Assume that I need to find an area where I can see two peaks on the stock price chart. Well, this peak and this peak. If we bring these two peaks down parallel, exactly, in the same RSI area. The RSI also has two peaks. Look, guys, it has one peak here and another peak here. If we connect these lines, we get a line with a positive slope from the locus of the connection of these two peaks, and a line with a positive slope from the locus of the connection of the two peaks. SI, a line, but with a negative slope. When this happens, we call this phenomenon a negative divergence. The negative divergence phenomenon is so powerful, and the target it gives you is as follows. The negative divergence phenomenon says if I draw a line connecting the peaks of the chart, and that line has a positive slope. On the peaks of the RSI, a line connect, that line has a negative slope. From the second peak onwards, we witness a drop in the stock's price chart. Now, this phenomenon is very, very powerful and shows itself with strength and ambiguous. I want to bring another example so we can see it more easily. Well, look, guys, the chart of Cyper Company has shown an upward trend. We found a couple of peaks here. One peak is in this area. Another peak is in this area. I actually connected these two peaks. It shows me a line with a positive slope. But exactly, two corresponding peaks of this, I see two peaks on the RSI, and these two peaks have created a line with a negative slope. So a strong negative divergence phenomenon occurs here. Well, and after the second peak, we definitely have a significant drop. See, this drop has also happened. Yeah, let's go and look at another example together. Well, here, the metals and mining development company with the symbol, and you see the mines, an upward trend, one peak here, another peak. In the second corresponding area on the RSI, SI, I am seeing two peaks. The slope of the peak line high chart is positive, while the slope of the RSI peak line is negative, and this causes a drop from the second peak to afterwards. See what a sharp decline has appeared on the stock price chart. Let's see if we have another example. Well, here again, you see the Persian Gulf Holding Company with the symbol, you see FAR Cement with the symbol CFARS, an upward trend. Here, I see peaks that from the geometric location of connecting these peaks form a line with a positive slope. But on the RSI, you see the RSI peak is completely showing a negative slope. It indicates, gives on different areas, and this causes us to have a phenomenon of two, or negative divergence, and after that we witness a significant drop in the stock's price chart, and then that's it. All right, let's move to the next slide.